Good morning. Hello, good afternoon to our audience. I'm Raymond Karam, the Chief Program and Development Officer here at the AGSIW. Thank you for making the time to join us for this webinar, taking a closer look at Gulf Sovereign Wealth Funds. We're really delighted to be co-hosting this program with ABANA, the preeminent U.S. organization for finance professionals and institutions with interest in the Middle East and North Africa. I want to welcome our good friend Majdi Ramadan, the Executive Director of ABANA, who is on screen with us this morning, and give him the floor.
Thank you, Raymond. Hi, all. Thank you for joining. I'm Majdi Ramadan, Executive Director of ABANA. We are thrilled to be convening this event on the role of Gulf sovereign wealth funds locally and the world economy, and the first one of our series with the Arab Gulf States Institute. We're extremely pleased that we could be joined by our board member, Zubaid Ahmad. Thank you to all the speakers, and we look forward to deepening our partnership with AGSIW. Back to you, Raymond.
Thank you so much, Majdi. I'll go ahead and just welcome our speakers and moderator and briefly introduce them here. I invite you to read their bios on our website, which I will share through a link in the chat. But I'll start alphabetically with Zubaid Ahmed, the founder and managing partner of Caravanserai Partners, a merchant banking boutique offering advice on a range of M&A and sovereign advisory, strategic capital raising, and private equity transactions. Previously, he was vice chairman of Citigroup's institutional client group and managed a number of different groups, including serving as co-head of Global Asset Managers Group, where he led Citi's global coverage of private equity funds, sovereign wealth funds, and pension funds, family offices, and other alternative asset managers. Also with us is Omar Syed, Chief Investment Officer, Strategic Investments at Mumtalakat, the sovereign wealth fund of Bahrain. Prior to joining Mumtalakat earlier this year, he was Senior Vice President at Daiko Group, where he was responsible for managing private equity investments globally for the family office. He has also previously worked at the Abraj Turkey Fund, where he was responsible for raising the fund while managing a team of investment professionals in Turkey across sectors. Last but not least is our good friend Rachel Ziemba, who is an adjunct senior fellow at the Center for New American Security. Her research focuses on the interlinkages between economics, finance, and security issues. She also serves as a strategic advisor at Alpha Z Advisors, an equity futures fund, and as the founder of Ziemba Insights, a macroeconomic research firm that focuses on connecting policy and macro risks for emerging market investors. She was previously the head of emerging and frontier markets and co-head of research at Robini Global Economics. Moderating the session today is my colleague Robert Mogielnicki, Senior Resident Scholar at AGSIW. He is an expert in the political economy of the Middle East and North Africa and has authored several book chapters on the politics and economics of Gulf Arab states. His latest book, A Political Economy of Free Zones in Gulf Arab States, was published by Palgrave Macmillan's International Political Economy series in April 2021. And with that, Robert, over to you.
Great. Thank you very much, Raymond. Thank you, Majdi. And of course, to my fellow panelists and everyone joining us today. Let me just set the scene very, very briefly with some opening remarks. It's safe to say that Gulf sovereign wealth funds and other government-controlled wealth vehicles are major players in the global economy. And we don't have to look very far or very hard to see them making a splash in the news. With the Public Investment Fund of Saudi Arabia being involved in a takeover of Newcastle United Football Club just very recently, to Abu Dhabi's Mubadala expanding their sovereign investment partnership with the UK to the tune of about $13.8 billion over 5 years. That's up from an initial pledge of just around $1 billion earlier this year. And a couple of weeks ago, Qatari officials were discussing the prospects of Qatar Investment Authority co-investing with the Asian Infrastructure Investment Bank in PPPs across emerging markets. So this is by no means a comprehensive list, but it does give us a good sense of the multifaceted and ubiquitous positions of Gulf sovereign wealth funds within global investment flows. But many Gulf sovereign wealth funds are also at the front and center of domestic economic strategies and local development plans. If I go back to the PIF, we see the Sovereign Wealth Fund playing a key part in the newly announced Saudi and national investment strategy, which in some cases does look like an amalgamation of previous initiatives, but the PIF was a central feature in a lot of those initiatives as well. And we're seeing more and more of the capital expenditures in Saudi Arabia being shifted from the national budget to entities like the PIF and other national champions. Kuwaiti sovereign wealth funds, for better or for worse, are being sucked into the country's fiscal challenges, with the General Reserve Fund's assets being used to fund year-on-year fiscal deficits, and also other legal changes to the funding stipulations around the larger Future Generations Fund. And then in Oman, the big news was the combination of the two wealth funds under the Oman Investment Authority. And the new minister at the OIA has been tasked with improving the transparency and efficiency of government investments. So one really gets the sense, stepping back and taking a look at Gulf Sovereign Wealth Fund developments, that what once might have been narrow, risk-averse investment mandates have in many cases evolved into much broader sets of responsibilities. Or at the very least, we're seeing Gulf Sovereign Wealth Funds setting about to accomplish a diverse array of objectives. So to help us make sense of this evolution are three experts on the subject. They were already introduced, and their impressive bios can be read in more detail at your leisure on our website. So I'd like to jump right in and move to Zubaid with an opening question. Zubaid, you've worked in the sovereign advisory roles, in various sovereign advisory roles across the globe. Could you give us an idea about how you would classify or situate Gulf sovereign wealth funds amongst their global counterparts?
Thank you, Robert. It's a pleasure to be on this panel with the other distinguished panelists, and look forward to having an engaging discussion with the panelists as well as with the audience. As you mentioned, I actually started covering the Gulf sovereign wealth funds in about, I guess, 2006, 2007. So for me, as an observer as well as a practitioner, it has actually been an extremely gratifying period to see the evolution and the increasing sophistication of these funds over that period of time of about 15, 20 years. And we will touch on that in some of my comments at the outset. I would say that, if we look in the last 2 years, and as we say, what a difference a year makes, after a very difficult 2020 with the COVID-induced economic shutdown, as well as the significant decline in oil prices, which had already been in a long-term declining trend, the funds had to go through a challenging period. Initially, obviously, there were lots of concerns that even though many of these funds were restricted from having to spend in the local economies, that the reserves may be drawn down to address the domestic budget deficits, which were looming large. And as those things were being resolved, that put a pause in the global investment activity of these institutions. However, as the COVID cases started stabilizing towards the end of last summer, and the global markets being flush with liquidity, many of the GCC sovereign entities were able to raise significant amounts of capital, roughly 75 billion in the international debt markets, which in turn reduced the pressure on these sovereign wealth funds to fund the domestic budget deficits. And as we have seen the continued stabilization of the oil prices in 2021, we have seen, again, a significant pickup in the domestic, as you said, as well as the global investment activity. One particular sector that I'm sure we'll be touching on quite a bit has been a significant increase in venture capital and technology investing, in large part being driven by the common belief that we have seen the acceleration of some of the many underlying trends as a result of COVID, and that getting into the right companies during this time are going to result in significant appreciation in these asset values. So with that macro overview, to address your specific question, when we look at the Gulf sovereign wealth funds, I would say that we find the most diverse set of objectives being played by the Gulf sovereign wealth funds as opposed to their peers in Asia or in Canada. And some of them have multiple objectives. As you mentioned, they range from being managers of state-owned enterprises, to fiscal stabilization funds, to being allocators in the global investments to help diversify away from the oil revenues, the so-called future generation funds, to also being sovereign development funds. We also continue to see the establishment of new funds in the last couple of years. In particular, we have seen ADQ in Abu Dhabi, as well as the Sovereign Wealth Fund of Egypt. Just to highlight a couple of examples of, Robert, what you were talking about in terms of the multiple objectives these funds are performing. Mubadala, which obviously is the second largest fund in Abu Dhabi, began as a sovereign development fund at its inception, and actually coined the terminology double bottom line, which meant that the fund would only invest in those international companies that would not only provide an adequate return of capital on a standalone basis, but also bring back their capabilities to help Abu Dhabi develop and diversify the local economy. That's where the inception was, but today, as you look at Mubadala, it's truly a global investor across a range of regions, as well as the types of opportunities, as well as through different vehicles like Mubadala Capital. And we would see that some of the same trends now are being followed, as you mentioned, by the Public Investment Fund, as well as the transition of Oman Investment Authority from mostly being a global investor to really focusing on this double bottom line concept in the diversification of the Omani economy. On PIF, as you said, it was initially established to manage the kingdom's stakes in the major state-owned enterprises, with the goal of, over time, corporatizing and privatizing these entities and using the funds from those proceeds to deploy into both global as well as domestic investments. So today we see that it's actually performing all three objectives. It continues to harness the state-owned enterprises. The most recent example was the IPO of Aqua Power, the largest renewables platform in Saudi Arabia, a couple of days ago, to being a global investor. And we have seen a number of marquee investments, but most of them do have a tie back into their helping Saudi diversify as an economy, to being a sovereign development fund. And again, we'll talk about the number of initiatives that have been put forward by PIF. There is a misperception, by the way, historically, that a future generations fund, the so-called future generations fund, should only invest internationally to help diversify the local economies and to create opportunities for future generations. But a lot of countries, not as much in GCC, but certainly in Saudi Arabia, where you have the largest number of 15 and below population, and the country has to actually create jobs to really make sure that this population is taken care of. The focus on future generations is as much on the development of the domestic economy to create those jobs and to provide that stability over the long run. And that's why 80% of PIF's focus in terms of their deployment is on domestic investments and diversifying that economy, and only 20% globally. A couple of other points I'd like to touch on before stopping, that we are also seeing, and the sovereign wealth funds are playing various degrees of roles in this, that for the first time, there have been many times where there's been a discussion of diversifying the local economies and reducing the reliance on the energy markets. But everyone's feeling is that this time around, in the last 18 months to 2 years, there is truly something different, because we are seeing a very different type of commitment. And we are seeing that through the privatization of many entities ranging from Abu Dhabi to Saudi and potentially Kuwait as well. And that these sovereign wealth funds will continue playing an important role in redeploying the proceeds from those monetizations into both domestic development as well as international investments. And the last thing I would say is, again, the investment activity is truly global. The US market continues to be the favorite for all the reasons that we know, including the most rapid recovery coming out of COVID. And those investments that PIF and other entities made have turned out to be extremely profitable. But China and India also continue to be very strong markets, especially in the tech space. China obviously has been given a pause recently because of some of the policy changes and some of the issues surrounding their tech companies. But India, again, continues to attract a massive amount of capital from the Middle Eastern sovereign wealth funds, both in traditional entities as well as in telecom and venture capital entities. So those are some of my initial remarks. I'm going to stop there and happy to expand on some of these comments as we proceed through the panel.
Thank you very much, Zubaid, for giving us that bird's eye view. I want to move over to Omar now to hone in on the Bahraini context. And we're very delighted to have him here and to speak specifically about Mumtalakat as well and his role there. So, Omar, I mean, what are some of the investment-related opportunities and challenges confronting Mumtalakat and really driving your work on a day-to-day, quarter-to-quarter basis?
Yeah, so look, thank you, first of all, Robert, for inviting me to participate in this. And it's a pleasure to be speaking with the fellow panelists. It's a great question. It's as Zubaid sort of opened up. It's been a very difficult period. 2020 was an extremely challenging period, not only for sovereign wealth funds but for the global economy. So for us, the challenge over this period has been about how do we support and work with our portfolio companies to really help them transition and maneuver through this extremely challenging environment. Mumtalakat is a very active owner and investor in each of its portfolio companies. As you've seen from our portfolio, we own some of the largest and most significant strategic assets in the country. So the focus for us has been really about rolling up our sleeves, working alongside our portfolio companies to drive value and to really take the opportunity to actually recut these value creation plans. The world has changed, the economic environment has changed, and the plans and ambitions that one would have had 3-4 years ago are completely different. So what COVID in one way was almost an opportunity for us to step back, reset, evaluate these businesses going forward, and assess how we can extract value and support our portfolio companies. So to give you examples, as you know, we own a significant majority stake in McLaren, which is a super automotive luxury company with a racing team. Please do support them. It's a great Formula One team. But more importantly, they went through an extremely challenging period. As you can imagine, with dealerships closed, markets closed, the inability to access customers, we were in a pretty difficult situation. But we actually rose to the challenge. We saw that as an opportunity for us to step alongside our management teams to reevaluate the new business plan of how do we want to reposition that company, how do we restructure that company financially. And as you saw in the summer, we went through a very significant refinancing of the business where we brought in £1 billion of debt and equity to reposition the business plan, to fund that business plan going forward. So that gives you, sort of one example of really where we've had to roll up our sleeves and spend time, from a portfolio management perspective. That's really where we've been spending most of our time and effort. On the investment side, as you've seen from our portfolio, most of our assets are concentrated within Bahrain, largely because we as Zubaid mentioned, we started as a state-owned enterprise. We owned a lot of assets that were transferred from the government to the Mumtalakat balance sheet, and that launched about 20 years ago. And so over time, the goal is to really extract value from the portfolio, generate and unlock capital through the value creation actions that we're driving, and diversify that into what I would call indirect investments. So we've built a new team that is really focusing on investing on the fund side, whether it's public or private funds, and then selectively looking at co-investment opportunities that we believe we have a high conviction and we believe that there's an opportunity for us to bring value to the table. One of the learnings for us, Robert, as part of this process was it's very hard to manage an international direct portfolio if you are not on the ground. So we own assets in Spain and Germany and the UK, and I couldn't get out to our portfolio companies, let's say in the UK, because we couldn't physically get out there. So a key learning for us was, it's challenging to do this unless you have local teams and local presence on the ground. And given where we are at this stage, we don't have that sort of team structure and international presence that allows us to be interventionist in each of the opportunities where we are. So as a process of growth and development, our strategy has shifted from doing direct investments in international companies into a more indirect fund strategy, which we believe brings more value to us. And secondly, we can choose the right deals from a co-investment opportunity that we have a high conviction against. On the local side, like most Gulf sovereign wealth funds, the topics that are of high interest are food security, health security. How do we position the economies to be able to, weather another crisis if that does come? It's no secret, it was a challenging period for the GCC when a lot of countries shut their borders down in terms of food and being able to access those critical food elements for the local population. So there's a big drive for us to focus on investments that really help us to harness our own food security and independence, and at the same time, what more can we do to strengthen our health security and initiatives within Bahrain?
Great, thank you so much for those opening remarks. Let me now move over to Rachel. Last but not least of our opening remarks here, Rachel really has her finger on the pulse of sovereign wealth funds and a number of other financial portfolios. But Rachel, how do you see regional sovereign wealth funds carving out, or in some cases being requested to, if that's the case, to perform new roles across the Gulf? Are you seeing them falling back on traditional objectives and strategies, or experimenting with new ones? What's your take on the lay of the land?
Thanks, Robert, and thanks to the Gulf States Institute and ABANA for involving me, and I'm honored to be here with the fellow panelists. So I think the first thing I would say would be to harken back to something Zubaid sort of started out with or laid out, which is to say that we have a number of different financial actors here, and their mandates really depend on the needs of their sponsor governments, their alignment with sponsor governments, and those sort of starting points. And so I think it's natural with new global shocks and new changes in global finance that mandates shift. Where things can become challenging is when mandates overlap and potentially conflict. And to some extent, as somebody whose work on sovereign funds started, 15 or so years ago, around 2006, some of these issues about overlapping mandates and push for transparency have been issues that have been around for a long time. So too has been a debate about domestic versus international portfolios. What I think maybe has shifted is both a comfort level in the global economy with greater state role from a range of actors. We see even the US and Europe being maybe more comfortable with managed trade than they were, a decade or so ago. But what's also shifted is the need and some of the demands at home, even from some of the richer countries with larger balance sheets. Now, and those Zubaid and Omar have sort of highlighted the fact that there have been some domestically oriented strategic development actors for a long time. But what I think is relevant here is that this time for expecting there would be dividend payments paying into sort of fiscal plans is much closer. And so if I think about it, there have been a couple of structural changes for the Gulf broadly, which have brought some of these issues to the fore. The first one, of course, is that oil revenues and oil savings are lower now. I know that sounds a little weird to say when we compare it to the last 12 months or 18 months, but structurally you've had a decline in revenues and you've had an increase in domestic spending needs, even in countries whose fiscal break-evens are lower. You also have this encroaching in question mark about how to climate stress test and carbon stress test a range of balance sheets, something we'll come back to, and I'm sure. and the like. So this urgency that the COVID crisis, I think, only reinforced of needing to make sure that domestic development plans could be more effective, that has only increased. That being said, I think there's a tension, and the case you cited, the Newcastle PIF one, I think brought it to bear. Is this one about sovereign funds as public sector actors? And I would look at it and say, well, the best sovereign funds are ones that are integrated into the national balance sheet and are part of a plan and connected to fiscal plans. Maybe they don't have government intervention every day. There's a division of labor, but they shouldn't be seen as completely non-connected actors. So the fact that you would have an assessment that they weren't a public sector actor seems a little bit odd. But there was this push in the global market to say that sovereign funds should be business oriented, which mostly they are, that they should be based on investment returns, which mostly they are. But I do think that there's some opportunities that can come from thinking about how they fit into sort of national strategies. And because I think anything that would lead to misalignment with national balance sheets would probably not be in the long-term interest. I'll conclude by sort of saying that one of the other shifts we've seen, and again, I'm generalizing in an area of diversity of funds, diversity of countries, has been an ability of some Gulf countries to choose to take on more government debt because the costs were low, rather than selling off liquid or especially illiquid assets. And, we can have our questions about sustainability of the fiscal policies, but to some extent, the same issues that we're facing in developed markets about the choice of where you spend that money is most important. So overall, I think this sort of point is, yes, there is more demand for spending locally. There will still be some savings funds and largely internationally focused actors. I mean, I would note in an Abu Dhabi context, ADIA had not been receiving much new capital for many, for the last several years. It had tended to go to more development-oriented actors. But I think there's interesting questions, and I think the push on providing, in some ways, this push towards different elements of the national balance sheets, raising capital on global markets, more privatizations in debt and equity markets, actually increase some of the information that both national citizens but also broad market actors have on some of the liabilities and interconnections. And this is, I think, we're in an environment where there's greater push on global regulations and reporting standards and the like. And so I think all of these sovereign funds, like any investor, are having to sort of grapple with this. I'll stop there. We can look forward to getting more into some of the details.
Yeah, thank you, Rachel. You gave us a lot to dig into. And one of the points that all three of you picked up on was how Gulf sovereign wealth funds are balancing the international, regional, and local investment opportunities. So I'd like to start my questioning with Omar on this point, and then move to both Zubaid and Rachel to pick up, to perhaps move beyond the Bahraini context and look at how Gulf sovereign wealth funds outside of Bahrain are balancing the international, regional, and local investment opportunities, and some of the opportunities and challenges there. But to start with Omar and Mumtalakat, on the website, your website, it says that 60% of Mumtalakat's investments are currently in the MENA region. And you did say in your remarks that it is difficult to manage investments without bodies on the ground. So my question is, do you expect this regional distribution to change over the coming years? I mean, more investments in the MENA region, or perhaps more investments outside of the region? I'm curious about what the strategy is there.
Look, it's a great question. I think in the short term, we will remain focused on investing in Bahrain to support our local economies in some of the key sectors that I mentioned to you: food security, health security. Similarly, to give you an example, one of the portfolio companies that we have is ADAMA. ADAMA is a real estate developer, and comes to Zubaid's double profit line question. We are heavily focused on what we can do to help ADAMA grow and invest funds behind ADAMA so that we can develop large-scale beachfront developments in Bahrain on the south coast of the island. We have beautiful beaches. There's untouched, southern part of the island that's never been developed. So the focus is, what can we do to really drive our local economies and focus on our local economies to drive impact and to bring value for the country. In terms of, I think the international exposure that we'll be looking at will be more on the indirect fund side, as I mentioned, because we see the opportunity to, invest with high quality managers that we believe can help us diversify our risk-adjusted returns, as opposed to going direct and developing those portfolios by ourselves. And at the same time, as I mentioned earlier, selectively looking at key co-investment opportunities that not only bring us the right return profile, but also help us to bring value to the local economy. So where we see an opportunity where that deal or that opportunity has linkages to the local economy, will be very value additive to the discussion going forward. I think where you will see a change in Mumtalakat's allocation is going to be more from the direct. We're heavily concentrated. I mean, you've seen the numbers. We're heavily concentrated in a number of large investments. So the focus will be to reduce that exposure in these large investments, recycle that capital into the indirect fund side. So if you're going to see any major shifts in terms of recalibration or rebalancing of the portfolio, it will be largely towards diversifying away from the concentration risk in these large assets towards more indirect fund related investments.
Thank you very much. Zubaid and Rachel, are you, outside of Bahrain and with other Gulf sovereign wealth funds, are you seeing a similar calculation, different calculations in terms of that distribution of international, regional, and local investments? And then just to bring in one of the questions coming in from the audience is, does the focus that appears to be widespread across the region on health, technology, food security, these kind of high priority sectors, to what extent is there competition between the different Gulf sovereign wealth funds as they chase deals within these high priority sectors? So over to you. Why don't we start with Zubaid, and then we'll move to Rachel.
Lots of different questions there, but let me try to address maybe two or three of those. Number one, in terms of deciding between domestic and international investments, the prism or the metric that I have always used, I mean, we get very excited by the absolute size of the sovereign wealth funds in a given country. We get very excited about assets under management per capita. But the metric I've always used for the Gulf is assets under management per capita of the indigenous population, excluding the expats, okay? Because that's really ultimately the worst case scenario for these countries, right? And so when you look at it from that metric, the countries with the strongest assets per capita of indigenous population are Qatar and UAE, okay? And so I think those countries are the most able to actually have a more flexible view on global investments as opposed to just driving the local economy. Not to say that that's not important, but there are other entities within these countries. So the ex-CEO of QIA, Ahmad Al-Syed, as you may know, is now the chairman of the Qatar Free Zone Authority, which is similar to the Kizad Industrial Zone in Abu Dhabi, where they are, and part of these geo-economic funds that you talked about, Robert, whether it's with the UK or the UAE-China industrial partnership or the Saudi-China industrial partnership, Qatar had it as well, is to really find ways to bring companies from these other parts of the world to help develop that local economy. Not necessarily through QIA Mubadala continues to play that role, and ADQ is now playing more of that role, but there are other pockets. But then when you go to Saudi Arabia, right, where we talked about it's the largest population domestically, it's a very young population. The country really needs to drive job creation there. And I think rightly so. And this is, I think, the overall evolution of these funds, that maybe initially it was great to splash with the marquee trophy properties globally, but now people are really focusing on, what really needs to get done to ultimately provide a successful diversified economy. So 80% of PIP's investments are focusing on domestic investments and 20% on international, just to keep that balance. And in light of that, when I look at a Man City acquisition or a Newcastle acquisition, a lot of people say sports is the language of the young people, right? And what national pride the success of Man City has brought to Abu Dhabi and UAE more broadly, and hopefully, what Newcastle is hopefully going to do with Saudi Arabia, there is the double bottom line concept there as well, that sports is a big part of MBS's diversification of the economy and improvement of the entertainment sectors. And Newcastle could play a role in that double bottom line concept of bringing that into the country. So I think each one of these countries is tackling the issue of global versus domestic in slightly different ways. And I think we will continue seeing that differentiation in these markets.
Thank you. Over to you, Rachel.
So I think harkening back to this question, so I guess first thing I would say is, Zubaid is spot on. Sort of sports and a range of cultural activities are key to sort of economic development. And we've seen this in sort of different waves of Gulf sovereign fund foreign investment. And it's only one of the sectors, I would say, that defines a subset of investment abroad that is aligned with development plans at home. So you can say the same things about certain manufacturing, certain, aerospace, a whole variety of areas. So I think one of the important, questions here is also around defining those sectors. We've also seen a lot of investment at home and abroad on renewable energy, rollout of renewable energy and the like. And some of that looks to facilitating continued fossil fuel exports. Some of it's tied into moves towards domestic sort of net zero goals. Some of it is aligned with the funds themselves, how they are thinking about long term, what is going and the like. So there's a variety of areas, and I shouldn't say all investments are for the long term. We've seen plenty of examples from the sovereign funds over the last year, as well as other investors, of being opportunistic. Funds like the PIF in particular, where the timing was oddly convenient. Saudi Arabia was making a medium-term shift in how it managed its assets, rather than having the central bank manage most of the assets. They were shifting to the PIF. This was part of a broader reassessment of the balance sheet, and they happened to have more cash on hand. And they had some timely investments in the spring of 2020, some of which were exited, some of which they continue to hold on to. And so just because a fund is a long-term investor doesn't mean that you always sort of hold on to that. But I wanted to come back to this competition point. And yes, there is definitely competition among the Gulf funds, but it's not just a story of competition in the Gulf. It's also a story of competition. There are certain types of assets that sovereign funds, pension funds, other assets are looking for, right? And so that's been one of the issues. And one of the challenges I heard from sovereign funds in 2019 was concerns not only that public markets had gotten quite expensive in some of the sectors they prioritized, but also the private markets were. And you saw sovereign funds going earlier and earlier in some of the technology development chains, finding ways to invest in venture, in investments, angel investments. So I guess all I'm saying is there's some healthy competition and occasional collaboration. one of the most interesting developments in my mind from a development focus among sovereign funds has been this rise of co-investment platforms. We've alluded to a few of them here, but funds developed by countries often without a lot of savings, often outside of the Gulf, that have been designed to basically draw in foreign capital, deploy it, maybe de-risk it. India, for example, which we've already highlighted has been a successful attractor of Gulf capital, has been maybe one of the more successful countries there because they've been able to sort of create a bit of a one-stop shop to de-risk some of that capital. Russia, for example, relying more, and a lot of countries in sub-Saharan Africa and elsewhere. In some ways, I think this is picking up from tendency and preference among some Gulf sovereign funds to create sub-funds and regional sort of areas of focus, which we saw over the last decade and beyond. So I think that there are local issues in every jurisdiction, but there's also certain trends that are sort of common to global markets that funds are having to grapple with, and their sponsor governments are having to grapple with.
Thank you, Rich.
Yeah, I just wanted to sort of highlight a point that I think, look, there is competition between the funds, obviously, because there's everyone's chasing the deals, but I think there is also a collaborative approach that you see in the region. So to give you an example, I mean, the recent investment that we received through McLaren, PIF was one of the major investors in that deal, and the opportunity for them was to really build out exactly what you said. They want to build out the hospitality sector, and given McLaren's focus on Formula One, it's a big draw. And you've seen the race that's coming up. It's going to be one of the first race in Jeddah, the Formula One in December. So all these investments do have a strategic underlying parameter of how that brings value back to the local economy. And I think when we think about these investments, it's also about bringing. Remember, the average age of population in the GCC is less than 30 years old. This is a very young population. The population needs to be skilled. There needs to be long-term job development that's relevant, that will create opportunities for the future generations. So when you look at these automotive deals, whether it's Pagani or a Lucid or a McLaren, one would question, are these just trophy assets, or is there really real value that's being brought back to the table? And Lucid is a clear example of the goal is to build an automotive cluster within the country where you actually do create high value jobs. And we know that EV technology is here to stay for the future with where carbon emissions are going. So there are broader strategic parameters that are at play beyond this idea of trophy assets that you see out there.
And Robert, just to add to what Umar just said, I think it's interesting. Yeah, I mean, look, on deals where there is an auction process, there could be competition, but generally what I have seen, and again, this is gratifying, that there is more collaboration and there is more skin in the game in some of the Gulf countries trying to help each other with what they are trying to achieve in terms of this domestic diversification. So Omar's point on PIF coming into McLaren, partly to drive what we just talked about, but similarly, Mubadala coming into the sale, the 49% stake in the Aramco pipeline business with EIG, exactly. And India, with Reliance, the geo platforms, the retail platforms, $7.5 billion came from the likes of Mubadala, Adia, as well as PIF, right? They all went in there together. And the other thing on the technology companies is that the size is so large, and the rounds in terms of the different rounds before the companies go public are so many that there's an opportunity for different people to come in at different times based on their comfort level. So I take Byju's, which is the largest ed tech company in India, right? Initially, QIA came in 2017, but then ADQ came in 2020, and there were rumors about a couple of other Middle Eastern sovereign wealth funds going into it. So it's turned into more collaboration in certain cases, and then the ability for everyone to play in the playground as opposed to really trying to outmuscle each other into getting into these situations.
Great, thank you. Let's move on to another hot topic. It's ESG, one of the questions coming in here from the audience, and we were going to cover it anyway in our initial list of follow-on questions is, how have and how will Gulf sovereign wealth funds approach the growth in ESG in their strategy? So maybe we go back to Omar and then and work our way down. I'd be very curious to hear your thoughts.
Yeah, no, it's look, I can assure you that it's front and center on every board discussion we have. Especially when we are in our audit risk committees, strategic discussions at the board level. These are, I think we've got to separate this concept of that ESG is painful. I think ESG is good business, and I think that's where we focused on driving value within our portfolio companies to really see how does the ESG parameters bring good business to the table. And I'll give you, like, for example, on McLaren, for us, front and center is what do we do to develop the EV strategy for this business going forward, because in 10 years you will not be able to sell a car in Europe if it's not on an EV platform. So I think similarly, when we look at our other businesses, the big focus is what can we do to drive the clean energy focused strategies going forward. Alba is another example where, as you probably know, aluminum smelting is not a very clean process. But what can we do to really reduce the carbon impact that we have as an aluminum smelter? Because once again, green aluminum pricing and premiums are changing, tariff rates are changing. You will be locked out of key customers, which are high value automotive customers, if you don't really abide by the right ESG principles. So if for us it's about doing the right thing, but also it's good business. I think both of those things need to tie together from our perspective. So I can assure you it's front and center on our agenda in every portfolio company.
Thank you. Zubaid, would you like to jump in?
Yeah, I mean, look, I would agree with what Omar is saying. Look, it's front and center. People are focusing on it. People are trying to, in the Gulf, I think there is a more balanced view, as well as, more broadly. I mean, there has been, and focusing, first on the E part, there has been obviously a lot of funds globally have come out with mandates. We are getting out of companies that are in fossil fuels. I mean, look, that's all fine, but many others are saying, look, when an industry gets put in a corner like the fossil fuel industry has, especially not the producers, but the refiners and the distributors, that ultimately they will find the mousetraps that help reduce carbon capture, help reduce the environmental impact. And a lot of people are putting money, including Bill Gates, on technologies that actually help do that. So I think that's number one. Number two, obviously, I think Rachel touched on this, that a lot of people forget that there is a massive cannibalization, for example, in countries like Saudi Arabia. As Saudi Arabia industrializes, a big percentage of the oil production is actually used in domestic consumption, which takes away from the oil revenues. And so a big focus on the renewables and the EV space, yes, it's also good business in terms of what Omar touched on, but in the near term, it also allows for a larger percentage of your production to be exported to generate the oil revenues as well, right? And there has been a tremendous progress. I mean, UAE is one of the lowest cost producers of solar power in the world right now, right? So I think, again, we are in the early innings, but and then you saw that PIF just announced that they're hiring 5 people from the outside to focus on nothing but ESG in terms of how they conduct their business, both domestically and internationally. So I think we are in the early innings, but this is front and center in terms of both how people are looking at their existing portfolios, how they should invest, and really looking, for those who continue to use external managers, to look at managers who have done a particularly better job of trying to invest in companies which are on the front end of it, as opposed to others.
I'd just add and pick up on a couple of the good points that Omar and Zubaid mentioned. The first one, I agree that we're in early innings. In this way, we are at the point where sovereign funds in the Gulf, as well as their global counterparts, have been grappling with how to address this to different degrees for some years now. And there are more who are, I might point you towards some good recent work from the International Forum on Sovereign Wealth Funds and maybe the replay from some recent discussions on how sovereign funds are grappling with on environmental issues, including a good one from the OECD that was just before our session. So I think we're at the point where sovereign funds are all grappling, sort of with this. Some have been implementing, they're stressing their, portfolios in a way. I think that sovereign funds in the Gulf and elsewhere face the same challenges that other investors do, which is a lack of the fact there hasn't been a coalescing towards common data sources. On the one hand, larger funds themselves have more capacity to invest in data, to buy in data, to do a variety of things as their large counterparts in the pension fund and private sectors occur. But there's still sort of a patchwork of regulatory issues internationally. I mean, I would note that a couple of the big Gulf funds are founding members of One Planet. There's still questions about how that's operationalized. But I think there is one of the things I've been seen as positive in the last year is sort of a greater focus on the other part of the national balance sheet in some of these countries, the national oil companies and other assets, to think about where they fit in from sort of an ESG and even progress towards what do we mean by net zero. So to the extent sovereign funds are involved in those national conversations. And this is also another case where I think there's been interesting collaboration and sharing of certain approaches through groupings where sovereign wealth funds are talking to each other, whether one-off or through training and other sessions like at the International Forum of Sovereign Wealth Funds. So, there's not one approach sort of yet, but I also think there's greater focus on what's the longer term fiscal sustainability, including from those returns. And I know there's a great question from Justin Alexander, which I don't think we're going to have time to sort of grapple with. But thinking about how fiscal rules should change, that's something that the Russians, for example, have highlighted, that maybe they should be drawing less from their sovereign fund. I think in the Russian case, that's more an excuse just not to sort of spend on investment. But we're not talking about Russia today, so I won't take us off course. So there's more work to be done. But I think that we are seeing sovereign funds as long-term investors being part in sort of setting some of these terms, and asking additionally some of their portfolio companies, for example, where they are in sort of TCFD sort of disclosures. And a lot of portfolio companies might be operating in jurisdictions, particularly in Europe and elsewhere, where those financial disclosures are more and more required. I mean, the US is even moving along those lines. So this is a work in progress, but at least we're not still at the starting line.
Thanks, Rachel. Yeah, well, luckily, Justin gave us, I think, 2 or 3 questions to work with. So we should be able to get to at least one of them. Mm-hmm. Before we move to the question and answer period, and I know there are several questions for anyone else in the audience who would like to submit a question, please do so. And if you can stipulate a particular panelist you would like to address it to, we will try to keep things a little bit neat and tidy to get through as many questions as we can in just a moment. But before we do, there's one more topic I wanted to discuss, and I am asked on a regular basis about the degree that political considerations and interests underpin Gulf sovereign wealth fund operations and also access to investment capital. So my question to each of you is, how are funds putting in place frameworks and policies, or how are these frameworks and policies already in place and being implemented to, I guess, allay some of these concerns of political interference in investment decisions, but also insulate themselves from that, from influence itself and these, various fiscal challenges that emerge, as we are seeing in places like Kuwait and, periodically in other countries as well. Are these frameworks and policies, to your mind, successful? So those are just a couple of questions to grapple with. Please pick up on whatever part is of most interest and relevant to you. But why don't we, again, if it's okay, Omar, we'll kick off with you again.
You asked me the dangerous question. So Look, I think let's be honest, right? We sort of are owned by the kingdom. We're a holding company. So it would be naive to think we don't serve the national objectives and interests of the Kingdom of Bahrain. But I can tell you that, we have the right processes and framework in place. Our board is comprised of not only representatives from the government, but we also have private sector individuals who are represented on our board who actually serve on our different committees. So whether it's my board investment committee, the majority of those representatives come from the private sector. So there's a framework, there's a process, and then obviously internally we have our own process and framework to do that. But like I said, obviously our goal is to serve the national interests and objectives of the country. So that's something that you always have to keep in mind. But obviously we have the right frameworks and governance and policies and procedures to ensure that the interference is limited or mitigated through that process. And by the way, I mean, we are not only held responsible, we're held responsible by the parliament, we are held responsible by a national audit office. So everything we do is scrutinized at a very, very high level. So whatever we do needs to serve the overall objectives of the government versus a specific political objective.
Very helpful. Thank you, Omar.
Yeah. Robert, if I can just add to what Omar is saying, I would agree with that. I think, again, through the evolution and the sophistication of the funds over time and some of the measures that Omar mentioned, I think most funds have that in place. Even, maybe one or two funds where there was more influence of the senior people to make investment decisions. I think that's also waned in the last 5, 6, 7 years. I think it's much more structured with investment committees and the audit process that Omar is mentioning. And I think, again, there are different vehicles that have been established in each one of these countries to, let us say, focusing on international, helping certain countries in terms of improving geoeconomic partnerships, et cetera, rather than doing it from a sovereign wealth fund. Kuwait was one of the early countries to start the Kuwait Fund for Arab Economic Development, which is called Kuwait Fund, right? Which also invested in China, by the way, in the early days when it was an emerging market. But now you have the Abu Dhabi Development Fund, you have the Qatar Development Fund. These entities are now trying to play the role of trying to be helpful to quote unquote friendly countries or countries that can use the help of some of their rich cousins, as I say. And then even in terms of political considerations, as Rachel mentioned, in India, the government established, similar to RDIF in Russia, the National Infrastructure Investment Fund, right? And that was a vehicle that was able to get through the bureaucracy and some of the transparency issues, and a lot of funds invested through that vehicle to actually help support the infrastructure development of India, for example. Or as I mentioned, the UAE-China partnership, investment partnership. So I think the sovereign wealth funds, in terms of what they do on a day-to-day basis, I think it's fair to say that they are just acting as global sophisticated investors like any other investors to make the right decisions for their shareholders. And then they have set up different pockets which have been ring-fenced from any issues for the sovereign wealth funds to participate in some of the more geoeconomic or development goals of the governments in other parts of the world.
Yeah, I would only add that I think this focus on the sort of how sovereign funds fit into the sort of broader economic policy strategy of the government is really going to depend on each country. I think in some ways, after a decade and a half or so of trying to set in motion efforts to make sure sovereign funds are as like private actors as possible, we're now operating in a world where a number of governments are more comfortable. Perhaps the challenge is, I think, one around transparency. Now, I think Omar highlighted, Zubaid highlighted that there are a variety, for some countries and funds, there are a variety of pushes towards transparency, both sort of domestic oversight, but also to the extent that there is more links into global capital markets. sovereign bond disclosures require a lot more information to be out there in the, sort of in the press. Entities that remain almost solely private, or in this case, sort of public from a from a government structure perspective, maybe would have less of those dynamics. What I do think can be problematic, Robert, you highlight the case of Kuwait, where of course the public oversight of the fund has, I would argue, really constrained the country and the fund. And some of that is a nature of Kuwait's hybrid political system, which I'm not going to wade in on. Kuwait for a long time was one of the early funds where, yes, there was public grilling of the asset managers, of the managers, where there was a lot of oversight on what compensation was, but it sometimes played out in ways that the public scrutiny limited the ability of the fund to actually invest over sort of the longer term. So there's a difficult balancing act there. And this is where I think there can be, opportunity, there can be opportunities to think about, well, what is the structure that, that really works. There's some examples under development now in areas outside of the Gulf that I think are interesting around sort of, again, alignment of fiscal policy, alignment of economic policies. And I'm interested to see, for example, what efforts, for example, in the UAE around sort of national development commitments and the like, what's going to be the role for the sovereign funds in that? Is this more sort of an attempt to just put out, sort of a flag and the like? So I think but I don't want you to take away a view that, all decisions are political and the like, but starting from the point of the goal of these assets is to have funds available for the population over the long term and to serve the national interest is by its nature political. It doesn't mean it's necessarily bad, but it does mean that there's going to be different mandates, and we should expect that.
Oh, thank you. Thank you all for navigating that question. It can be a tricky one, but I know a number of people in our audience are certainly interested in it. Let's move to some of the audience questions. The first question I'm going to put to Omar, and then the second question I think would be good for both Rachel and Zubaid. So Omar, and I'll mention them both, and then we'll have a run at it. So one question for you is, Omar mentioned McLaren's refinancing, which involved the PIF. What scope do you see for further cooperation and co-investment between Gulf sovereign wealth funds? So that's for you, Omar. And then while I have the floor, I'll just put in another question here about state-owned enterprises and their relationship to sovereign wealth funds. What is let's just narrow it down to Rachel and Zubaid's view on the excessive debt of many state-owned enterprises impacting the fiscal strength of sovereign wealth funds, I guess, that are either in that portfolio or are part of coming, a process of being integrated into sovereign wealth fund portfolios. So let's turn the floor over to Omar, and then we'll hear on the second question from the other two panelists.
Yeah, so I think Robert, one of the key sectors that I believe is an opportunity to develop regional champions would be in the space of food security. I think that's a very critical topic for the region. It's an important topic that was surfaced, during the COVID period, given all the sort of lockdowns and inability to access the right, food for each of our different markets. So I think food security is probably an interesting area, and I think it also allows us to develop regional champions. I think the focus, rather than being each individual country on a subscale basis developing national champions, I think it would be more interesting to develop a regional champion that would have the ability to then expand, into other markets. So I think that for me would be an interesting focus area and opportunity. I think you're seeing that, ADQ is a great example of really how they're focusing on building a very, very strategic and focused, food platform across different verticals, whether it's protein or carbohydrates or dairy, etc. So I think there's an interesting proposition there for the regional sovereign wealth funds to work together on doing something cohesively.
Thank you. Over Zubaid.
On the same question or the other question that you asked?
If you'd like to follow on that question, by all means.
Yeah. Look, I think we will continue to see collaboration. I think I've already mentioned some of the deals, but on the other question, remind me again, Robert. I just lost my chain of thought.
Let me run it again. It was about state-owned enterprises. And
yes.
Between state-owned enterprises and sovereign wealth funds.
Absolutely. So look, one of the things that we have to remember is that on average, 70 to 80% of the employment in the Gulf countries is public sector, right? So if you talk about, and by the way, that's true with a lot of other developing countries as well. And so often the SOEs are used as vehicles to provide jobs and job security, even when it may not make sense in terms of the most efficient running of these organizations. So part of the challenge for all the countries in the Gulf has been, how do you really corporatize, which means bring efficiencies into these businesses, including reduction of debt, as well as, too much labor, prior to actually monetizing, because valuation is directly dependent on the health of the companies. But at the same time, you don't want to cause too much labor or employment loss, because that's going to create other issues. And so that's why the diversification of the economy in terms of creating new sectors to be able to mobilize and redeploy the workers that may be reduced in terms of the SOEs is part and parcel, right? I mean, it's all a simultaneous equation. So, now if it can be done well, I mean, obviously, the two classic examples of entities that were started as managers of state-owned enterprises were Temasek in Singapore and Khazanah in Malaysia. Temasek has obviously evolved into achieving its objectives, which is, over time monetizing Singapore Telecom, Singapore Airlines, and using those proceeds to deploy in global investments, and also continue providing platforms for the development of the Singapore economy, especially in the digital and the technology space. And I think ultimately we can see that in countries like Saudi as well. And ADQ obviously in Abu Dhabi has now been given the ownership stakes in a lot of the SOEs there. And the goal, I think, if you hear the CEOs of these entities, their focus is really to try to bring that balance of how do we improve the operations of these companies, reduce debt, monetize them at the best value that we can, and then not only redeploy the workforces into other parts of the sector, but also redeploy the proceeds from these monetizations into both domestic as well as international investments. So it's not an easy task, but again, I think we are in the early innings, but the commitment is to make sure that it's done in a way that is a win-win for everyone at the end of the day.
Rachel?
Just sort of picking up on this question of the debt burdens, and I would say probably also assumed future sort of, liabilities, including especially in some of the more carbon intensive sectors that are among, but not only in the sort of, SOEs. So I think Zubaid and Omar in different ways have highlighted that there can be sort of different structures chosen to house and sort of reassess sort of management and reassess sort of the liabilities. Some of the question is one, I think, that needs to be viewed at the nation state or sponsor entity level and thinking about the like. Now, if a sovereign fund ends up with these assets and implicit liabilities, obviously they have to share. And we've seen, for example, growing pains involved with consolidation of, for example, some of the many different, Abu Dhabi funds when Mubadala took on sort of incorporated in Taka and some of the others. We've now seen, a sort of, reestablishment and creation of different entities. But that's why I think throughout all my remarks, I've kind of tried to come back to this sort of thinking about the national balance sheet. And that I think it's quite important to think about what sectors and what assets are going to be, valuable over time. I'm not trying to sort of dodge the question, but just to say that some of it has to be, and increasingly, I think it'll be important for investors in some of the listed assets of the, in the countries, not necessarily the sovereign funds, to be thinking about what are the implicit and explicit, liabilities. The interesting question also, almost any conversation on sovereign wealth funds starts out with the fact that, well, sovereign wealth funds often don't have explicit liabilities. They're not like pension funds or the like that have pension payouts. And that's where we might see more differentiation between, in a sense, the types of sovereign investors that have more liabilities, whether to public markets and the like, and are more active, have to be, in a sense, more transparent and issues. And can make the life of people like me who spend time looking at fiscal balances of countries, makes it a little more difficult, but it also makes it more interesting. So I think I just come back to this issue of alignment with national interests and the like, and why it's important to have good links with sponsor governments.
Let's pick up on the point of entrepreneurship promotion. We see a number of regional sovereign wealth funds, investing in or creating funds of funds to make more of an impact on the ground in the entrepreneurial space within their economies and also across the region. So I guess I'd be curious to get a view from each of you about what is the preferred method by various sovereign wealth funds to influence and to make a splash in the entrepreneurial space across the region. How are you seeing the deployment of investment capital playing out and the entities, the preferred entities being used?
Should I give a crack?
Yes.
So I think we're using a multifaceted approach. I think, first of all, we believe that investing in funds to grow and establish an ecosystem that can thrive within our national interests is absolutely important. So, for example, we've invested in the Al-Waha Fund and other such funds that are venture capital funds that focus on investing in young Bahraini entrepreneurs that have great ideas, necessarily don't have the capital, but need the funding and support to do that. So we see that as one vehicle to do that. Also, within our own portfolio companies, we're creating opportunities to invest in disruptive technologies. So if you take Betelco as an example, our goal is to grow away from being purely a mobile operator, but actually developing a forward-thinking, digital services company. So how can we create an ecosystem within Betelco that allows young entrepreneurs to develop their ideas, incubate those ideas, fund those ideas, and develop those digital adjacencies? The other arm, there are many different arms. This is just the sovereign, right? Then you've got the EDB, which is on the Economic Development Bank of Bahrain. There are many initiatives that they are undertaking to really create an ecosystem. Zubaid, you probably know this, right? Citi just moved their digital operations to the region. That's going to create a huge opportunity for young Bahraini coders to have an ecosystem to thrive and grow. And it's a multiplier effect, right? As those people grow, as they develop those skills, then they will then have the confidence, to do that. And by the way, it's not this can't all just be the sovereigns. Don't discount the Kareem Mafia. I mean, I know they're called the Kareem Mafia, but the Kareem story created immense knock-on impact across the region. So, it's so important that, we continue to inspire that entrepreneurial and technological, expertise within each of our economies, because the knock-on impact is massive. You now have Kareem entrepreneurs in Egypt, in Jordan, in Saudi, in the UAE, spurring new companies, new ideas. So I think it just can't be sovereigns. I think it's the whole ecosystem that needs to feed this, but it's an important aspect of each of our economies.
Yeah, I think Omar has summed it up really well. Aside from Bahrain, the combination of the Bahrain Economic Development Board, which has been on this journey for the last 3 or 4 years and has really created the overall infra in the country to allow the entrepreneurs to be successful. The same thing can be said about Mubadala. And, Mubadala is as I said, they have established different entities. So Mubadala Ventures was created about 3 years ago. They have offices in San Francisco, in Abu Dhabi, and London. They are investing directly into some of these startups globally, but then they're also investing as little as $5 million in local startups in Abu Dhabi. And obviously, Public Investment Fund of Saudi Arabia has also taken a big chunk of its money to invest as a fund of funds, Robert, into domestic entrepreneurs in the technology space in Saudi Arabia as well. So I think we are seeing what we would call public-private partnerships, right? Because you have to create the ecosystem first, and the environment for success, and then through both private sector mobilization, and we are beginning to see foreign investment in some of the startups in Middle East, because there are some really amazing companies that are being spawned there.
Rachel?
Nothing. I think Zubaid and Omar have covered this well. I've just reinforced their points.
Well, then let me turn to you with the next question from the audience. So I'll give you a tough one here. To what extent do the perceived investment successes and failures of the flagship development funds ripple across domestic societies? Or to put it another way, as fund profiles grow in domestic discourse, are the funds also becoming nationalist symbols or icons? So pretty, deep question there. So curious to hear your thoughts.
Yeah, well, I mean, I guess I would harken back to comments we were making earlier about some of the more visible and sort of entertainment and sports linked sort of entities. I think those are among some of the investments that perhaps have reverberated most domestically in certain societies. One of the challenges always with sovereign funds has been that it's tended to be the foreign investments that are more visible, and particularly investments that were made not through sort of intermediaries and the like. I mean, there's still a lot of cases where domestically and internationally you might sort of fixate more on the relatively small percentage of the portfolio that is visible, that is visible, as opposed to that which might be through intermediaries and the like. I think we've already, alluded to the political pressure in the countries where there is sort of domestic oversight and the like, particularly Kuwait. I will say that in my mind, very few of the Gulf countries have the same degree of kind of political and national, well, by their nature, the political systems are different. This is not Norway, where sometimes the sort of asset allocation of the fund is a major decision point over which, as a major talking point in the electoral platforms of different parties. So I'm not trying to sort of combine, sort of different things. So look, I mean, I think as funds become more and more active domestically and through these different innovative channels we've just been talking about, they are more a case of discourse. There is more, in some cases, scope for, concerns about where, sort of where money is being spent. But in the conversation, but I think it's sort of still a bit early to say exactly what the impact or the discourse domestically is. But some of the other panelists may have other thoughts on that.
I just want to add something here, maybe to create a little bit of a debate here, but on two of Rachel's points, right? I mean, Kuwait, yes. there are lots of issues. But what I would say is, on a positive side, despite all the issues in Kuwait with the parliament and the maybe too much screening of what's going on in KIA, they have stuck to their knitting and they have had enough support to stay the course. And as a result, they are one of the best performing funds, right, in the Gulf over a long period of time. And I think one of the things that Kuwait KIA decided was they know what they don't know. And so they have obviously had 95% of the funds in the FGF being invested through external managers as opposed to doing it directly. And as we see in the last 5 years, the returns from FGF every year have exceeded the oil revenues of the country. So despite all the pressures, what's nice for me to see is that they have stuck the course, they have performed extremely well. The second thing on the national balance sheet and the question of political influence, I think sometimes we pick on the countries outside the US too much, because I always bring the example of TARP, T-A-R-P, 2008, global financial crisis. And I said the US actually came up with a different type of fund, which I call a sovereign bailout fund for the banks, right? So essentially that's what we did. It was important for us as a nation to protect the banking system. And we printed a lot of dollars to put 750 billion into a bunch of banks to bail them out. So why is that different than what Kuwait or Saudi Arabia or Bahrain may have to do from time to time in order to preserve some of what they need to do? So I think sometimes we kind of overdo it. But the fact is that these are agents of the government. They will do both, what their prime objective is, but from time to time they may get called on to help support the domestic needs. And I think that should be expected. And I think we should allow them to do that.
Rachel, any follow up on that, or should we move to the last question? If you have something.
Just very briefly, I mean, Zubaid, your example of TARP, but also some of the other things, including PPP loans and other things like that, are exactly examples, and the European Recovery Fund, right. Are exactly examples of this sort of comfort level of using, using government tools to sort of do what's necessary in the government interest. But you're right, in the sovereign space, there's often a lot of talk about sort of, how Ireland, for the Irish Fund, for example, shifted their assets and said, well, what's in the greatest national interest during the global financial crisis? It's not investing in these other areas. It's investing in property linked assets that if they go down, they will undermine. In the case of that, and of course in TARP and some of the other sort of Treasury and Fed purchases, of course, like a sovereign fund in the Gulf, they might be able to come back and say, well, actually, taxpayer got a good return on that. That's not always, sort of the case, and hard to do the result. I mean, I think the rejoinder, of course, comes back a bit to this question mark of what's a domestic oversight, how does that materialize? But yeah, I mean, I think you're, sort of, it's very right in thinking about, and I guess the interesting question mark, and we see this elsewhere in the world, is what's the institutions you put in place to determine, it was clear last year, it was clear in 2008 that this was a really rainy day, and that's why rainy day funds exist. But how do you define when something is, sort of severe enough, and what the role of different actors, should be? And that's where I think the right sort of alignment, and it's not sort of everyday oversight, but the right sort of alignment of here's our broad goals over a period of time, and then you can kind of come back and, address that. And I do think this greater involvement, sort of domestically, these different roles, will give more opportunity there. In some ways, I think the flagship investments that we've seen out of the Gulf have maybe prompted even more angst and concern. And well, why didn't we do that, say, from the Brits, right? The Brits, for example, and also people in in parts of Canada and parts of the US might almost have a bit of envy of, why didn't we think about sort of constructing these things in that way? So maybe it's the flip side of your question, Robert.
Great. Well, thank you.
Sorry, I digress.
No, not at all. It's good to have that debate. Our time is winding down, but I believe we have time for one more question. I'm going to pose it to Omar. The question was, I guess it implied that there were outsized COVID-related fund returns, and the question is, how has this impacted sovereign wealth fund strategy? And the reference was made to university endowments posting in 40% returns. I guess to make it a little bit more specific, because I don't have those exact figures and the return stats in front of me. But Omar, at Mumtalakat, what are you looking for in terms of your expectations and your targets for returns? As we're coming out of this COVID period, which in the beginning you mentioned was a very, very difficult period, a difficult period and a challenging time for investors.
Mm-hmm. So, look, in terms of the returns that people saw in 2020, it depended on your risk appetite on going into the market in March 20, right? And how you sort of rode that cycle through and the corresponding returns. I think that's why what I tried to explain earlier was our portfolio is heavily concentrated and illiquid at this stage. So the goal is really to sort of deconcentrate that portfolio, create more liquidity in the portfolio. So when those opportunities do come, we can capitalize on those opportunities. And those that did, Mubadala is a great example. I think Khaldun and team went heavy into that. They did really well through that period. We unfortunately did not have the liquidity in that point to be able to capitalize on a cycle correction like that. In terms of our return expectations, I can't disclose that, but I can tell you that we're looking at double-digit expectations, within our portfolio, both within the direct and indirect portfolio.
Thank you very much. Zubaid, looks like you're going off mute. Any last comments, and Rachel too, before?
One of the things that is always a struggle, right? On the one hand, sovereign wealth funds are expected to have a long-term view because they don't have, quote unquote, the liabilities that Rachel had mentioned, right? On the other hand, we start comparing them with other market players, right? So a $20 to $25 billion endowment in terms of the ability to move, the investments in that to time the market is very different than a $700 billion aircraft carrier, right? It doesn't move as quickly. And if you are asking the sovereign wealth fund managers to actually invest for the long run and not worry about the movements up and down, then it's really not right to compare their returns with anyone else out there. And I think that's always the balancing act. But despite that, the returns that have been disclosed to some extent by the funds in the Middle East have ranged anywhere from 20 to 30% plus in many cases. And obviously they benefited from some of the market improvements, including the mark-to-markets on the private side that have occurred post the crisis. So I think that's always, again, a big debate. And my view is, if they're going to be long-term investors, let them perform on a long-term basis.
Rachel, we'll let you have the last words.
So sorry to interrupt, Syed.
No.
I was only just going to agree wholeheartedly. It's notable, of course, that many sovereign funds, both in the region, but also their peers in Singapore, for example, prefer to report returns over a multi-year basis. Some of that, and that's been a bit of a compromise, right? So that goes back to the point you were making about Kuwait and those sort of long-term returns, but also trying to avoid getting caught up in that sort of short-term sort of thinking. That's also where I think some sovereign funds, like other long-term investors, experimenting with things like clawing back, compensation either internally or to external managers for sort of shorter term, sort of thinking. In a sense, larger funds might have more ability to negotiate and set new different, fee structures and the like. That doesn't always work in practice. But ultimately, I think it goes back to what Omar said, how you did depended a bit on not only risk appetite, but whether one could be nimble and what one was invested in. But I do think that's where certain choices that were made to stabilize, to avoid sort of selling illiquid assets at a low when it was hard to price them, mean that a lot of countries did well. Now the question mark always comes back to what's that, sort of what's that money sort of, spent on, and how, sort of what's the bigger question I think that a lot of sovereign funds are facing is that after some really strong market returns, it's going to be harder, not only because they're big, but it might be harder to generate the kinds of returns we saw in that period of time. And I think we're already seeing, that sort of funds try to sort of, grapple with it. And it may be necessary to set expectations, again, back to the sort of sponsor governments and others about what those, medium-term returns are going to look like, particularly in a period of sort of divergent economic growth.
Great. Thank you so much, Rachel, Zubaid, Omar, being so generous with your time, as well as everyone who joined us here today remotely. Please join us again for future events and programs and publications as well. And thank you again to the panelists, and look forward to seeing you all again soon.
So thank you so much.